The International Monetary Fund has cut its economic growth forecast for Singapore to 3.7% this year. This is down from its forecast of 4% GDP growth that it made in May. The IMF country report also says that headline inflation is expected to remain high at 4.8%. It praises the government's handling of the pandemic, but it says the hardest hit areas like tourism, aviation and construction remain below pre-pandemic levels. And for more on this, we are joined by Rajiv Biswas. He's APEC Chief Economist at S&P Global Market Intelligence. Well, Rajiv, a headline inflation forecast of 4.8%. How does this compare with the higher Singapore Central Bank forecast of 5 to 6% for the year?
Well, clearly, both forecasts are indicating very elevated inflation this year. As we're seeing all around the world, many countries are showing rising inflation pressures due to the impact, particularly of commodity prices, which have surged in the early part of this year. And particularly, the key factor for many countries that's driving up inflation is higher energy costs, and that's very much the case also in Singapore, with rising prices for oil and gas in world energy markets. That's been an important factor pushing up Singapore's inflation rate. We have seen some easing of energy prices in recent weeks, but given geopolitical risks that are still very much evident, particularly the Russia-Ukraine war, this is going to be a very volatile time for energy prices over the remainder of 2022. So for Singapore, inflation pressures will remain elevated for the rest of the year, but we do expect inflation in Singapore to be gradually easing during the first half of 2023.
So then do you think the MAS is likely to continue its tightening moves up ahead? Because you said inflationary pressures are likely to persist for the year.
I think the near-term inflation outlook does remain challenging in Singapore, as it does, in many other countries around the world. We're seeing that in the US. The Fed's been tightening aggressively. The ECB now started tightening as well, and many other central banks globally, as well as in the Asia-Pacific region, have been tightening policy. Inflation pressures are still high. So I think that environment is still persisting in the near term, and there is the risk that further tightening will continue in the months ahead. However, the external demand environment is becoming more challenging, with growth momentum in the US and the EU also slowing. The US is actually at risk of entering a technical recession. First quarter GDP growth was already negative, and there's a high risk the second quarter could also turn out to be negative. And although domestic demand in APAC has been more resilient, nevertheless, there are a lot of headwinds to growth, which may temper the views of central banks in terms of tightening too much further.
Yeah, and Rajiv, the IMF has suggested in its report that Singapore uses fiscal policy as a first line of defense against downside risks. But where is this sweet spot between supporting growth and taming inflation?
Well, really, there is that very difficult balance at the moment when inflation's still very high. And, the government needs to take action to continue to contain inflation. But in the case of Singapore, domestic demand has been, I think, helped by the easing of COVID restrictions. Since April, we've seen quite a lot of easing of measures, which is helping to boost retail sales, particularly for food services in restaurants, cafes, and so on. And also what's very important is the continued easing of international travel restrictions, which is helping to boost international tourism, much more business travel into Singapore, and also we're seeing the restart of international conferences in Singapore as well. So all of these things are helping to support domestic demand without relying too heavily on more fiscal measures. Because after 2 years of the pandemic already, the Singapore government spent, around about $100 billion to mitigate the extreme shocks from the pandemic. And we need to shift now to a phase of normalization, living with COVID, and moving towards a more sustainable approach rather than continued cycles of fiscal stimulus packages.
Many thanks for speaking with us. That was Rajiv Biswas there from S&P Global Market Intelligence.